Hello everyone, welcome to Added Trade. Today we're going to be seeing a strategy that we can implement on the budget day, how to trade the budget day in buying options. This strategy is something that will give us very minimum loss and we might get some good profits. Okay, the loss might be minimum, but the profits might be good. Worst case scenario, as I mentioned, it will be a minimum loss strategy. This is a strategy to buy options. So this video is being recorded on 23rd Jan. The budget is on 1st Feb. So whatever example I'm going to show is with respect to this option chain, today's option chain, Jan 23rd, as per how the data is. But we can implement the same thing on 1st Feb. I'll be telling when to buy, what to buy, when to exit, everything. We don't know where the market is going to be on 1st Feb. It can be at a good high point or it can be at a good low point. So it can be either at a good high point or a low point. So wherever it is, I'll be explaining how to do this. See, what this strategy is nothing but we are betting on a big move on the budget day, either a big move on the upside or a big move on the downside. See, if for example on the last year, right, I'm not saying even this year we will move so much, but last year on, see, this is the Feb first candle for last year. I traded with the same strategy and it gave us good profit. Obviously we didn't catch the whole thing, we were out by 5%. This itself was good profit, so we were out, but even after that it went up 7%. If you see previous past budgets, right, there's at least minimum 3% move on the downside or upside, right? So it's never been that on a budget day the market has remained flat. If this is the first budget where in the Indian trading history, in the Indian stock market history, if the after the budget, if the market remains flat, at least until recent times, obviously I don't know more than 10 years, right? I've traded past 5 budgets and this strategy has worked. So there might be days where it would have been flat, so we are not looking too much into the past budgets. So what the strategy is, see, we need to buy at the money, call and put. Now what is at the money? The simple way of understanding at the money is wherever the spot chart is, right? Now for today, at the money is 37,500 because the closest strike price to 37,500, we have closed at 37,570. So the closest strike price to 37,550 will be the at the money. So at the money can either be 37,500 or 37,600. So what we do is, this is a sensible option chain that I've taken. Even you get the same data in NSE option chain or any broker that provides the option chain data. Take the strike price that is at the money at 3:20 p.m. on 31st Jan, on Monday. So 31st Jan will be a Monday. So what you do is on 31st Jan after 3:20 p.m. or even 3:25 p.m. if you can execute, it is well and good. As closest to the end of Monday market on 31st Jan, buy at the money, what is mentioned here, at the money, call and put. So for example, now for this current chart, at the money will be 37,600. I buy one lot. Now the lot size depends on everybody's capital. Even if somebody is paper trading, please do this paper trade and see, it will be a profitable trade and the loss will be minimum. So I'm just checking for one lot, then we'll see for 10 lots and 20 lots, 40 lots. Now let me just click on analyze. Now this example is, again I'm telling you, this example is shown for today, but what strike price the Banknifty might be on 31st Jan, we don't know at 3:20 p.m. That we will have to see it on 31st Jan itself, but the strategy, the logic that we are applying will remain the same, that is buying call and put at the same strike price. So what I did here is I bought, if you can see here, I bought 36,600 call one lot, 37,600 put one lot. Now say minimum Bank Nifty just moves about, say we are at 37,600, right? And obviously over here how the profit is calculated is also different because we have 3 days left to expiry, Monday, Tuesday, Wednesday, for today's example. On on Monday, it'll be like 2 days left to expiry. So now just consider a movement of at least say even until 38,200, where the Banknifty moves at least 2% on the upside. You will be in a profit of 2,000. See here on this black screen where I move, it's changing, right? On Monday is what the profit you will be in, plus 2,900. If you hold until expiry, it shows minus, obviously. Sorry. So even if you get like say about 2% move for an investment of 19,000 over here, net premium what you paid, obviously this again will be different for one day before the budget. We can roughly make about like say 2 or 3,000, which is pretty decent, where you're going with a cover strategy. Like in case even if the market falls, you'll be making money. Now just assume it is something really good comes out of the budget. We see a move of at least 5%. Okay, that is around 1,300 points or 1,200, 1,500 points. We can see a profit over 20,000 at least for one lot. And the same thing on the downside. Say we just move about say about 1% or 1.5% down at the max. This calculation is again for this day, right? That's why it's showing minus 500. But on that day, you even if 1.5% or 1% you move down, you will be in profit. Okay. Say a 2% down move will give us about 1,000 profit, but on the 1st Jan, a 2% down move will give us really good profit. And say consider a good fall of at least say about 5%. Again, you will be in like 20 or 30,000 profit for one lot. See, last time for one lot I got 20,000. I had more lots, but for one lot what I got is about, I had 10 lots up, 10 lots down. So for one lot I got about like say 19,500 or 20,000, I think. So if I just show this PNL table, what happens is, now say we get a good move of say 2%, just an example. Okay, so the put value reduces and the call value goes up and you will be in profit. The same thing on the downside, you move around 2% down, the call value reduces, obviously put value increases, you will be in a profit of somewhere close to 1,000. Obviously the calculation will be different, but the logic is this: buy at the money, call and put, same strike price. At the money meaning same strike price. Okay, and when you will be buying this is, you will be buying this on 31st Jan after 3:20 p.m. This and see when we can be in loss, right, in this strategy. Say this is where the market opens on 1st Jan, so on 1st Feb, and throughout the market we get some big moves up down. Your PNL will be changing plus minus, but overall it will be in plus and a little minus. Say for first time after a long time, say the market remains flat with no move. It closes just about 200 or 300 points below or 300 points above at 3 o'clock. Only at then you will be in a loss. The time value will reduce, and if the volatility is high, the VIX will fall and the premiums will fall, and your loss will be a minimum. So the advantage of taking at the money is, say even if you fall like say 500 points down and close, your put would have gained some sorry, your put would have gained, the put value would have gained some profit, right? If I show it to you on this chart, say now we are here and the put would have gained some value and you will see some profit, and the call, obviously it won't be much profit if it closes within 500 points. Maybe you will see a profit of like 500 or 200 rupees, something like that, but still we won't lose our entire money, right? Now when we can make good profit is, say throughout the day, throughout the budget, we are going up and down, we are volatile, and say some at the end of the budget, post 130 or something, we get one wild move on top. This is when we make the most profit, or we get a wild move on the downside, is where we make most profit. If we remain flat within like say a 500 point range, right, only then you will be in loss. So now coming back to the strategy, so when we'll exit, the buy time is after 3:20 p.m. Make sure it is before 3:30. even 3:25 p.m. you can execute. I executed on 3:28 or 3:27 because last year it was the budget was on Monday, so we had Saturday, Sunday, 2 days of time value decay. So I wanted it as little as possible. We executed post 3:25. So this time the advantage is Monday is 31st and first is Tuesday is first. So the time value decay is very less. It's just 1 day. Last year we had 2 days. And whatever happens, right? Whatever happens, this is not a Thursday where the option premium is going to become zero, right? Out of the money. So whatever happens, you'll just lose a little bit of time value. The loss will be less. So the best time to exit is post budget speech, post 1:30. From 1:30 we can see if where the move is coming. If the move is good, it's continuing going up, you wait. Probably around 2 p.m. or 2:45 p.m. is a good time to exit. Now, one thing that needs to be strictly followed in this is, otherwise we could see big loss. Okay, that what needs to be followed is, I'm going to bring this point up here. Wait a minute, let me just try and clear this. So this is the most important point, that is at whatever time you are exiting. Okay, see, if people can hold until 3 p.m, 3:15 p.m, well and good. Okay, say this is the market timing. We start at 9. Okay, we are getting pretty whatever sideways move, and later in the afternoon we get that violent move up or down. If we can hold until 3 p.m, it's good. If somebody wants to exit for some reason, say we got a good up move. Okay, we got a slightly good up move, and say you're in a decent profit. For one lot you have made a profit of 5k, and somebody decides to exit. You will have to exit both. Okay, that is CE and PE at the same time. Exit both at the same time. Okay, the same thing even if the market falls. Say for some reason the market falls, you're in a good profit, you're in a plus. For one lot you're in plus 5k, or say you're in plus 10k, and for some reason you decided to exit. You see, the profit appetite and the loss appetite depends on individual, right? Now somebody is happy with this 10k profit, or somebody is happy with 5k profit, they want to exit. Well and good, you can exit when your PNL, when your overall PNL is showing plus 5k or plus 10k, you decide to exit. So what your calculation will be, see, you invested 19,000 and I'm making a profit of 10,000 and I want to exit. So in that case you will have to exit both the call and put. Don't now say the market has fallen, you have made plus 10k, don't exit this put and hold this call. Okay, what if the market falls even more? This call value will reduce, right? So exit both at the same time, that is call and put should be exited at the same time. Okay, that is the most important point. And the other scenario is, say the market till 3 o'clock it remains flat. Okay, we open 9 o'clock, say we open at 9 and this is 3, until 3 it remains flat. You are seeing a loss of minus 4k, or say a minimum loss of minus 2k. Okay, say you're seeing a loss of 4k or 2k, and you feel that okay, you invested on 19,000, I've lost about 2k, I want to exit. Again, exit both. Even if you're booking your loss, you book both at the same time. Now what if that one move comes at 3 p.m, shoots on the upside, and you have just exited your put and if you have exited your call and holding put, you lose more money. So if you're holding, hold both. If you're exiting, exit both. That's the plan. So this is a good strategy. It will work. If somebody is not trading, doing paper trading also, you can try doing paper trading on Monday. So the logic is, see, make sure you are buying the same strike price. Okay, that is, I'll just reiterate on this option chain. At the money you buy a call and you buy a put. Okay, and you'll buy at 3:20 p.m, after 3:20 p.m, as late as possible. even 3:25 p.m. and make sure your order is not MIS, which is intraday. Make sure it is positional. In most of the brokers it will be NRML or something, right, or CNC something. So make sure it is this, because I had this problem last time, but luckily I had time to re-enter. One of the budgets I entered MIS, it got squared off at 325, auto square off. Then immediately I had to reopen a position in the positional category. So make sure it is not MIS, MRL, and exit time is post budget, say about 2:30 or 3 p.m. Now there's another scenario where you can go in loss, that is, say we get some good news in the budget, or for some reason the market shoots up, okay, and it takes resistance at some level and suddenly dips by 3 o'clock back to the open, or at least half. So again, in this scenario, this is less likely to happen, but if something like this happens, again we will lose money. So the best time to exit is this post 2:30 or post 2. See if you're in good decent profits by 1:32, okay, and hold on to the trade. If you're in good decent profits, just make sure you exit both. Never exit one and hold one. Now say your call is in good profit, don't exit the call and hold think the market will fall, or the same thing other way around. If the market falls initially, now say what happens is, where this gets confused, right, where in one of the budgets I took a hit like this in my initial days is, now say one good point comes in the budget, the market shoots up like say 500, 600 points, okay, then a negative point will come in the budget where market falls again, say 200, 300 points. Same in both Nifty and Banknifty. So what happens when this up move comes, you will be in plus 5,000 or something, okay. So what our mind will tell is, okay, we are plus 5,000, will exit. If the market falls again, I'll exit put. And what from here the market shoots up, you will lose this 5,000 in your put premium. So even if like this move comes, you're in profit, you want to exit both. And in the put also, if you're making profit, exit both. And for some reason, if you miss 3:20 p.m., right, you can at the max re-enter on the morning at 9:20, not at 10:11 when the budget is almost in session. Best time is 9:20, is where you can re-enter. And the same thing can be applied even for Nifty. If you take Nifty chart, go at the money, okay, choose the whole number like 17,700 or 17,600, buy, call and put, and exit it at the same time. I personally will be implementing this strategy and trading. I'll be showing my P&L also, how much I made. Now let's just see if somebody has enough money to take a bigger lot size of say at least 20 lots. Call and 20 lots put. So 20 lots is 500 quantity. Analyze. Now say you get on, first we'll see for a 1% move, this is showing loss, but you calculate this on a Monday, you will get to know the exact profit and loss. Say it happens to be a good move on the upside, say about 3% minimum. Okay, you can see a profit of at least 1.5 lakhs for sure. And the same thing on the downside. If a fall comes about 2.3%, you can easily see a profit of 1 lakh or so. Only if it remains flat, you will lose some money. And for 20 lots, roughly the investment will be around 4 lakh. And again, the investment will differ on Monday. If the VIX is high, the premiums might be high because of volatility. So we'll have to consider all that. So this is the basic logic: buy at the money, call and put on at 3:20 p.m. 31st Jan and exit post 3:30 2:30 or something when a good move comes after the budget. And one thing to remember is, if we don't follow this right, we can see a big loss in a P&L, that is exiting both C and P at the same time. If you're booking loss, say for one lot you invested around 20,000, okay, one lot call, one lot put, you invested around 20,000, and now you have kept a loss target of say 2.5. If I lose 2.5k, I'll exit, close this position. So if you're closing this, close both P and C, don't close only one, because that can lead to a bigger loss, because we'll never know, no support, resistance and all will come into play. Everything will get broken if the market starts moving on one side. So keep this loss in mind. Say you put 20,000, say I take a max loss of like say 2.5 or 3k, and profit obviously depends, like whenever you see good profit you can exit, but just make sure you exit both. Even I'll be personally implementing this. Hope the strategy works, and that's it for the budget day trading strategy, and I'm sure this will work out.